Today I'm talking to my longtime friend, Jeff Hudson. His specialty lies in commercial real estate debt and financing at Walker Dunlop. Jeff has helped to finance more than $10 billion of loans across many property types, including office, industrial, retail, apartment, hotel, mobile home parks, and mini warehouses. Today, he structures loans throughout the country that range from $1 million to $500 million in size.
It's nice to chat with you. I don't know how often I get you to myself, but I'm happy you're discussing this.
I feel like a rock star here. This seems like a DJ booth.
Yeah.
You want to talk about the new album and stuff like that?
Totally.
Okay, well, we're trying some different stuff.
As long as we play that same kind of music on the webcast, that was fantastic.
Oh, yeah.
So I think you should write a book. First off, because you deal with agency loans, CMBS loans, bank loans, with insurance companies. You work and finance RV parks, hotels, retail, industrial, all different types of assets. And then different operators who have their completely different, unique business plans. How did you get from studying law and getting your JD, and then going into the finance debt markets?
Yeah, but it's an interesting question. It was really pretty serendipitous because I went to law school at night. I sold real estate during the day, single-family homes and apartments.
Wow, okay.
And I got out. I practiced law for a short period of time and absolutely did not enjoy it.
Wow, okay.
Fully enjoyed law school, loved the education, loved the discipline, loved the kind of mindset which you and I have talked about before,
Right.
which is kind of seeing things from a completed vantage point and then figuring out what steps need to be taken to get back to where you are and then go back out to the completed. And so it was, from a mental perspective, it was a good move because my mind works better in a non-confrontational, collaborative manner
Okay.
than lawyers do.
Okay.
I don't really enjoy going in there and just beating people.
Right.
So as a financier, if you're going to do more than one deal and just retire from it, you've got to leave both parties happy. Mm-hmm. The lender, the investor, the seller, they've all got to be happy. The buyer, the borrower, the developer has also got to be happy.
Right.
So it must be a win-win. But on the other hand, the clients that we represent have to feel that they've got the best possible deal that was available. Mm. And so to your question about the kind of landscape of projects that we work on, it does seem like they're broad. I mean, you and I have known each other for a while. We will finance anything from an empty out pad in a tired shopping center up to a $500 million stock co-op,
right,
in Santa Monica.
Right.
I mean, we basically do everything, and so it may seem like it's more complex than it is. Any transaction, whether it's the empty retail project in a strip center up to a $500 million stock co-op, always turns on three different things. It's always the same, and they must be present in any real estate transaction. And it is basically the borrower, the cash flow, and the hard asset. And it's a three-legged tripod. Okay. And if anything is wrong or missing in those 3 points, it would be great if it were 4 because the tripod can stand on 3, but since it's 3, it won't last. So an example would be, let's say starting small, a fourplex. Someone wants to buy a fourplex in Santa Monica, and they are bringing in all their friends and family. They have very little net worth, but they've got friends and family, and they are willing to bring in 25-30% of the cost of the project. That borrower will have a bit of a problem going out and putting together the transaction because, just theoretically in this hypothetical, they're too weak.
Right.
Lenders want to see net worths of anywhere from minimum 2 to 3 times the loan amount that the borrower is borrowing and a minimum liquidity within that of 10 to 20%.
Okay.
So looking at the hypothetical in Santa Monica where somebody's buying a fourplex, and what would that cost? $2 million today?
Yeah.
Yeah? So
Maybe more, but yeah.
you really need to have a borrower who is worth at least $4 million and has net worth of liquidity of $400,000.
That's incredible.
It's a lot.
That's a huge barrier to entry.
It's a huge barrier to entry
Yeah.
if it is an investment property.
Right.
If it's an owner user, or if it is a 1 to 4 where the buyer is going to move in, it becomes a residential.
Okay. So
And-
that was one of the questions. That's the difference, I guess, between commercial and residential loans.
Right.
It gets underwritten totally different.
Totally differently.
I thought that commercial was more based on the income of the asset, not as much on the individual.
Well, that's okay. That's the one step. So we're talking about the borrower.
Uh-huh.
Even if it's a non-recourse loan, which means the borrower doesn't personally guarantee or promise that he will pay back the loan, which
Okay.
means the lender has the opportunity to foreclose on the property and nothing else. That's a non-recourse loan. Lenders want to see borrowers that, one, have the background and sophistication, even to buy a fourplex in Santa Monica.
Yeah.
Two, they have the cash flow on other properties so that if they lose 2 tenants in that fourplex in Santa Monica, they're not underwater.
Okay.
And that there is enough cash flow on the property that it justifies support for the loan.
Okay.
And so we talked about the borrower, where the borrower has to have adequate net worth. The cash flow of the property is critical, because if it's completely empty, then there has to be enough of an analysis to show how the property is carried, it is released, it is occupied at market rates, and then the value is based on that.
Okay.
So, number two, the cash flow on the property. Amazon being the tenant in a property for a 10-year lease is totally different than Jeff Hudson being a tenant in a property with a startup sock company.
Right.
Both paying the same rent. This run with Amazon almost becomes like a bond. It's like a credit lease. Lenders will look at that, and they will look at Amazon if they're in there for 10 years, and they'll say, what's the bond rating for Amazon? If Amazon sells bonds, what are they selling them for? Well, it turns out it's probably about 2%. So they are a
Right.
bond-rated credit company. So the lenders can look not only at the real estate, but also at the credit of the tenant. So
Right.
they've got a great deal with Amazon in there. Look over at Jeff's new sock company, brand new startup, never sold a sock in his life, but likes the idea, and his wife just wanted to get him out of the house. That's not a very strong tenant and not a very strong cash flow.
Right.
So from a lending perspective, the qualitative spectrum, you are going to get the top quality lenders with the lowest rates for the same building with Amazon in it, and you will get weaker lenders who will charge more, and they will be tougher to deal with Jeff and his sock company.
Right. Okay.
So that's the cash flow of the property. So the third leg of the tripod that we were talking about, the property itself. Properties become obsolete. And one of the better examples is an industrial building which was built, say, in the 60s, all over Los Angeles, and you can see them. They've got the bow truss ceilings. They're older buildings built 50 years ago. A lot of support stanchions throughout the building. It's an obsolete model for users today.
Okay.
Some buyers are coming in and using that for creative office space and blowing it out and making it something nice, but for its intended use, which is industrial, it's not happening. New industrial buildings now have clear heights, ceilings which are 20 to 40 feet high,
Wow. Okay.
because it's all about volume in industrial, unless it's going to be converted to a different use.
Right.
Right? So that building, that old building with a bow truss roof in an area where new buildings are coming in which have a tremendous amount of storage, is functionally obsolete.
Okay.
So the third leg of the tripod, the actual physical asset, it must be up to date and marketable.
Okay.
And without that, it's not readily financeable. Now, with the three legs of the tripod, there are mitigants when one leg is short,
Right.
right? So if the borrower has a net worth which is inadequate, borrower may bring in a partner, borrower may get a lower loan to value,
Okay.
borrower may have a cash reserve up front. There are ways to mitigate that weakness from the borrower.
Right.
On the cash flow of the tenant, if it is a short lease, lenders don't particularly like the risk of the tenant moving out unless it's a very well located property. You know, I'm looking out your window here, Santa Monica Promenade. Somebody's going to go in and lease it if somebody moves out.
Right.
The rents have gotten a little bit high, so we're starting to price out a number of users, but that space will always be occupied. The only issue is how much rent they'll get for it.
Right. Yeah.
So the cash flow is extremely critical, but if it is either short because of the short-term lease or it has other issues to it, again, there can be mitigants. Lower loan to value. You can go back to the first leg of the tripod, which is the borrower, and the borrower can guarantee the loan if the borrower has a substantial net worth.
Right.
So short-term lease on a well-located building, tenant could move out in the next year. A strong borrower comes in and says, I will sign and I will personally guarantee the loan, and I'm going to replace the tenant when they move out.
Okay.
And so we're able to mitigate the weakness in the cash flow of the building by the borrower.
Okay.
Okay? The one thing that is really difficult to mitigate is an obsolete building or a poorly located building. And I gave you the example before of an industrial building.
Yeah.
Another example would be, because I know you know the Central Valley, what has happened in Bakersfield and Fresno is, unlike Southern California, or at least unlike this area in West LA, areas completely change very quickly. Retail areas, shopping centers, and the classic example is the enclosed mall, which in the 80s was the hottest piece of real estate in the country. The enclosed mall, where you've got a Penny's on one side, you've got a Sears on the other, you've got a Magnum's. It is this 500,000 square foot enclosed colossus.
Okay.
And for years, for decades, everybody wanted to go there.
Right.
And then maybe 10 to 20 years ago, people started in areas like particularly Fresno and Bakersfield, they decided they're going to start over in new retail areas miles away from the old core retail area. And suddenly that area becomes in essence obsolete. And we had one project up there years and years ago where a very conservative family bought a Kmart, and they bought it on a 15-year self-amortizing loan, which, as you know, they just want to pay it off fast, and it's very conservative, relatively low loan to value.
Right.
So you've got kind of weak borrowers, but you've got a good tenant, which is Kmart, and the location was okay. Well, turns out as that market evolved and new product was being built 2 miles up, I think it was the 99.
Or 99.
Yeah, up the 99. Turns out our enclosed mall, or in this particular situation, our Kmart was not getting the customers anymore.
Right.
Kmart then goes bust.
Yeah.
And because of the fact that the location was, I guess you could say, becoming or had become obsolete, there was not somebody ready to come and move in and take over for Kmart.
Right.
Ever.
Wow. Yeah.
And so, I mean, the types of uses at that point were swap meets, storage, I mean, just nothing.
Yeah, and the rent's much lower.
Yeah, and so the borrowers who were not real estate people got a low loan to value, great, makes sense. Got a rapid amortization to pay it off as quickly as possible, good, that was smart. The problem was really beyond what they predicted, and that is the weakness of Kmart and the shifts within the community of where the new development was going.
Okay.
And so they lost the property, it was foreclosed.
Wow, that's incredible.
And they probably put 50% down.
Wow, that's
There was no
that's
solution.
sad, but it's Main and Main moves to a different location.
That's right.
That's something that we've actually talked to people about. We were looking at a deal a few years ago for a friend
Right.
in Augusta. I think that was what scared him away. He wasn't
Yeah.
sure if, you didn't know if Main and Main was going to be a different location.
That's
A
right.
little bit.
Yeah. Yeah, it's really like, I mean, it's like the old Wayne Gretzky line, right? People said, why, what was it about you that you always were where the puck was?
Yeah.
And that made you so great. How was it that you were always where the puck was? And he said, I was never where the puck was. I was where the puck was going.
Yeah, that's interesting.
That's where I went.
That's very interesting.
And if you're not buying or building within a dense infill location, you really need to know where things are going. Where is the puck going to end up?
Right. So you just talked about underwriting a little bit. And this is just out of my own curiosity. Because there's so many different types of lenders, the underwriting probably needs to be a little bit different for each of them because they each, I don't know how they each make money. I mean, the CMBS market, they resell, you resell the loans and you keep recycling money, I guess.
Yeah.
So is it the same for all of them in terms of that process, the way they look at it? Or?
No. That's a great question, and it's just amazing to me how few people really kind of follow the ball on that, and you do, and I know this. Lenders will lend based on the cash that they have.
Okay.
Okay, and so let's go categorically through the lending groups. Banks traditionally have money from people who have checking accounts, savings account. They walk in, they open it up a deposit, they walk back out. They walk back in the next day and they want to take a lot of money out. So the money is rapidly going in, going out, coming in, going out. And they've got backups from the feds, and they've got backups with other security for their deposits. But the money is constantly moving in and out quickly. So the type of projects that traditionally, particularly community and local banks would lend on, would be short-term financing.
Okay.
Construction.
Interesting, right.
Mini perm loans. They really don't want to do 10-year fixed rate loans unless they're selling the loan to another group.
Okay.
So because of the fact that, again, look at the bank, people are coming in all day long, that's where their money is. They need to know that they can get the money back, everybody who has a deposit over at the bank. And so the bank's investments are generally by nature short term. Now, the bank also lends to the borrowers and they back into the collateral.
Okay.
And that's another thing that a lot of people may not fully appreciate is most banks lend on a recourse basis, which means there's a personal guarantee. And so they will ask for a tremendous amount of data, and you know this already because you've been through the process with a number of banks that we've worked with. They want a ton of financial data and background on you, the borrower, before they even want to talk about the asset.
Yeah.
And so we walk into the bank and we say, I want to get a loan on that 5-plex or 4-plex down in Santa Monica. You say, great, Mr. Hudson, let's get your financial statement. Well, let's get this, let's get that. And I'll say to the bank, well, look, the financial statement is I've got X amount of net worth.
Right.
And relative to, I know what your underwriting standard is, I've got adequate net worth to buy this and I've got the capacity to buy it.
Okay.
Not so fast, says the banker. I want to see your financial statements, I want to see your tax returns, I want to see your K-1s, I want to do a credit check.
Right.
Because of the fact that I'm really lending to you
Yeah.
because you're creditworthy.
Right.
And yeah, the real estate's going to make sense, but you're not even getting to the discussion of the real estate until you pass the test of creditworthiness with the bank.
Right.
Okay?
Yeah.
Because they need to get that money back fast because of
Right.
where the money comes from.
Yeah.
They can't mess around with a borrower who just is flaky.
Right.
All right, so let's go over to the other end of the spectrum, which is really the long-term fixed rate, which has traditionally been life companies.
Okay.
Okay? Life companies get their money where?
Yeah.
Selling life insurance
Yeah.
policies. All right, life insurance policies traditionally are long-term payments by people like me who have been paying on their insurance for, gosh, I think I bought my first insurance policy in my 20s, so I've been putting money into my insurance for 40 years. And one of these days, I'm going to kick the bucket, and Sandy Hudson is going to pick up the phone and call our agent, Frankie,
Okay.
and say, Jeff's kicked the bucket, we need the money, we want it now. Okay, but meanwhile, Jeff's been putting in the money for years and years and years and years and years and years.
Yeah.
So the life company goes and looks at actuarially what the anticipated payout time frame is going to be on life insurance policies, on whole life policies, on annuities, on term life. They will say, Jeff Hudson will walk in there, age 68, say, okay, he actuarially has got another 12 years under the hood.
Ah.
Okay? So if Jeff buys insurance right now, we're going to anticipate that we're going to be paying it out in 12 years.
Right.
Okay? So they can make investments and they will match the maturity of their investments to the people that they're selling the insurance policies to.
Okay.
Now, they do all sorts of other stuff, obviously. They do. A number of our life companies do property and casualty insurance, too. Well, every 5 years, when the storms come in off of the Gulf, there is catastrophic damage.
Okay.
So those companies have to be a little bit more nimble, those life companies, when they're selling when they are selling policies for property and casualty, than those who are just selling life insurance, long-term fixed-rate life
Right.
insurance companies.
Right.
Because they have a little bit more risk.
Yeah.
But again, the way that the money comes into the life company dictates the type of loans that they do. It reflects that.
That's very interesting. I sort of had a question about that, and you sort of answered it with the banks. Because, how do you calculate inflation on a long-term loan that you have on your books? The risk of, I think it was the early 90s, we had 15% inflation.
Right.
How do they protect themselves when that could happen? I mean,
Yeah.
unlikely, but it is a risk.
Yeah, well, they generally will price their loans off of treasuries and off of corporate bonds.
Okay.
So the answer is, how do they know where inflation is going? One, they don't.
Right.
And two, the people that they talk to don't entirely either. But the people that they use to dictate what they're going to charge, which are the feds, they'll look at the treasury bills and they'll say, okay, a life company, like a life company is like a human being too. It's got a whole portfolio of investments. It's got cash. It's got equities. It owns buildings. It's got real estate loans. It's got municipal bonds. It's got corporate bonds. And so it's a whole tapestry of investments, starting from the lowest risk, which is a treasury bill, all the way up to the highest risk, which would probably be doing joint ventures.
Okay.
A real estate loan is way over on the conservative side, and the pricing that they will charge will be reflected by the amount of risk that they foresee in doing a loan as opposed to doing just buying a treasury.
Right.
So life companies today are loaning in anywhere from, let's say, 2.5% to 4% for a 10-year fixed rate loan.
Okay.
10-year treasury today is 0.75%.
Okay.
So the life companies are saying, in our portfolio, we're going to have this bunch of, it's generally up to about 10% of our assets in real estate loans, because we are getting anywhere from 150 to 200 basis points more than we would get if we just bought a treasury.
Right.
So again, looking at the whole landscape of their investments, they got their treasuries. They've got a bunch of those. They've got some corporate bonds. And they've got real estate loans. And they've got real estate equities. And they've got other things which are higher risk. And so the price that they charge is all based on the risk that they see compared to just buying a treasury.
Right. Interesting. So that is very interesting.
So they look more to, they'll look at the borrower, they look more to the asset itself and the cash flow. And they're less concerned with the borrower because they generally don't ask for recourse. Yes, they still want to borrow with a net worth of 2 times the loan. They just want that kind of a borrower, but not because the borrowers are guaranteeing it. They don't want to have that as a risk in their own mind.
Right.
They will also loan at lower loans to value than will the next category we'll talk about, which is the Wall Street conduits.
Okay.
Because they do not want Sandy S. Hudson calling up on the untimely demise of her husband, Jeff, and being told that the investments, sadly, that MassMutual made lost money. And sadly, Mrs. Hudson, we don't have it because our deals went bad.
Right.
Okay, the life companies can't do that. They'd be out of business, and they're backed up in certain respects, but that's the mentality. Lower loan to value, they will charge better rates, they don't need recourse, but they really want high quality. They just don't want much risk. All right, enter in kind of, and there's so many different buckets, but enter in the third kind of bucket, which is this alchemy that was put together on Wall Street some probably 30 years ago, which is a Wall Street conduit. And basically what they did is they would pool a number of loans together and then securitize them, which means put them in a trash compactor, pack it all down, anywhere from $500 million to $2 billion in this one pool of loans in the trash compactor. And then they will take that to Standard & Poor or Moody's or the rating agencies, and the rating agency will look at that, which is called a $1 billion pool, and they will say, okay, the top 80% of the loans are really rated AAA, rated the same as a AAA bond.
Okay.
Okay, the reason is if a loan is, say 70% loan to value, 80% of the 70% is 56%,
Okay.
which means the rating agencies are saying, okay, A-piece buyers, because they are bond buyers in the securitization, it's a 55% loan to value, the risk is very low, you're going to pay X amount of a rate, and it's over treasuries,
Right.
but it's not quite as high as what it would be for the next tranche.
Right.
So we chop this thing up. First 80% is the A paper. After that, that's AAA paper. After that, it goes single A, it'll go single B, triple B, and then it'll be unrated.
Okay.
And for each different layer, there are different rates and different risks. And so the last risk, which is really if there is a loss on a property, the top part of the loan is generally going to be getting, let's say in today's market, a 10% return
Okay.
in exchange for the risk of, if this property goes bad, you're the first one out the door.
Right.
You will lose.
Right.
Okay, so back to how the sausage is made. Wall Street basically takes a bunch of real estate loans and turns them into securities, bonds. And those bonds are sold in the secondary market by every Wall Street house imaginable. And you can buy AAAs, you can buy single A real estate CMBS loans, and you can buy unrated, and it's just, it's sold, it is transformed. That's why I call it alchemy.
Right.
From a real estate loan
Yeah.
to a bond.
Yeah. It's very
Okay,
interesting.
so All right, that's kind of where the money comes from. So now let's talk about why they lend the way that they do.
Okay.
All right, they are really 100% concerned with cash flow, because a bond holder or a bond buyer buys a bond to get a certain amount of return for the life of the loan.
Right.
He doesn't want breaks. He doesn't want to know that a tenant moved out, or that there's a recession, or there's this or that. He just wants his payments to come in.
Safe. Right.
Doesn't care about real estate. And the vast majority of the buyers of these bonds, particularly the AAAs and the higher rated
Right.
ones, they don't even look at the real estate. It's the guys who are the triple Bs or the high risk position that look very hard at the real estate, because
Right.
they're the first ones to lose.
Right. Right.
And it's all about the cash flow. And so
I see.
conduit lending is all based on preserving cash flow no matter what happens.
Right.
If a tenant moves out, okay, then we've got these trap doors and we've got these systems within the loan such that we have X amount of money which you, the borrower, have already been putting aside every month to carry the property in the event X tenant
Right.
moves out. And we have this amount of money left in our bucket to put out for the TIs and the leasing commissions, because they're non-recourse loans. We can't, the conduit lenders aren't going back to the borrowers and saying you got to kick in more money.
Right.
They're not. It's non-recourse, and the borrowers won't do it. And so they have to look at properties, and they have to structure their financing that they provide strictly based on preservation and protection of cash flow of that property.
Does that by nature make them less flexible?
Absolutely. You nailed it. It's a very rigid type of a transaction.
Okay.
And it's an expensive transaction if you decide you want to pay it off early, because remember, we had transformed real estate loans into bonds. And so you've got to, what we call, defease the loan, which is to turn that bond back into a real estate loan. And so what they would basically do is they would buy back all of the bonds, pay them all off. The borrower would have to pay the cost of that,
Okay.
because the bond buyers were promised X amount of yield over the whole term of the loan. And so to defease the loan, all the bond buyers must be made whole to the same level that they had expected when they made the original bond investment.
Okay.
And so again, that's a real long answer to why do different lenders lend the way that they do, strictly because of what they're told by the people who put money into their institutions.
Right. Okay.
Whether it's you and me with a checking account, is you don't want to go to the bank tomorrow and being told, Eduardo, really bummer, you can't have any money in your checking account.
Right.
There's a run on the bank, and the bank gets closed down when that happens. So that money's got to be available. So their investments generally are fast.
Right. Okay.
Other side, as we talked about, Sandy Hudson calls up, don't want to hear that you're having problems when Jeff kicks the bucket.
Right.
All right, CMBS lenders, the bond holders do not want to hear that pennies went bankrupt.
Right.
They don't care.
Right.
They want their payments.
Okay.
Here's the situation. Certain facets of the real estate business have been severely impacted by COVID, and you can name them. You can name the gyms, you can name restaurants, you can name any big box retailer where people cannot and will not go in shoulder to shoulder because A, they're not allowed to, and B, once they are allowed to, they're going to be uncomfortable doing it. So within the retail space, a tremendous amount of tenants are unable to pay their rent
Yeah.
because A, they're closed down by the cities,
Yeah.
and B, nobody's leaving the house and nobody's going in. They're all buying it on Amazon.
Yeah.
And so the brick and mortar retail has been severely, severely impacted by COVID, and it will take it years to come back. Apartments, on the other hand, particularly with the CARES Act and with checks going out to a good slice of the population, the collection rate, which maybe is normally 95%, is maybe 92% right now. Very little fall off.
Wow. Okay.
Office buildings, oddly enough, same thing. Very little fall off. And the reason is because the office tenants have long-term leases and there's not much they can do about it. And it's not often mom and pops in a lot of the office spaces, it's firms.
Ah, okay. I haven't heard that before, but that's
Yeah.
interesting. That makes sense now.
Industrial, there are very few delinquencies in foreclosures, if any at all, so far, in industrial, because they're still making widgets.
Right.
They may have to slow it down, they may have to change their schedules, they may have to do something different, or they may actually be closed down for a short period of time. But particularly in manufacturing, you can be plenty socially distant and be back up in Detroit making cars, or be out in the Central Valley outside of Bakersfield and storing tires for American Tire in a giant logistics facility, because people are still getting their tires.
Right.
And you still need and I'm thinking about one project we financed, which is a 1 million square foot box filled with tires, literally.
Wow.
And that goes back to what we were talking about before,
Yeah,
is
yeah,
obsolescence. It had like 40-foot ceilings.
Wow,
That was
yeah.
nothing more than a giant box.
Wow.
And so those tenants and those properties have done fine. So COVID has disproportionately affected retailers, and within the retail, gyms, movie theaters, just things that people are not going to be able to go back into with the velocity that they had been, are the most severely impacted.
Right. Do lenders look at trends as much as investors, buyers?
They
of
do
real
more
estate?
and more. They didn't used to as much. If it was a warm body with decent credit, the lenders didn't need to worry about that. I mean,
Right.
the traditional retail center was like a market, what we called a dumbbell center, a market drug. You got a Safeway at one end and you've got a CVS at the other, and all the happy satellite tenants in between have customers because people are going to Safeway and
Yeah,
CVS.
yeah.
That's a dumbbell center.
Yeah.
Then, it's evolved into bigger retail centers where the enclosed mall was the hot product. That's no longer the hot product. That's a whole different discussion. Now the retail centers, which are really the most popular, are Caruso type centers.
Right.
Which are, and people copying that. It is a combination of entertainment and having a good time and shopping.
Okay.
And it's not, it isn't as purely utilitarian as a market drug center.
Right.
Where you're not going there to be entertained. You're going there to get your diapers, and you're going there to get your ground chuck.
Right.
All right, there's not a lot of pizzazz in that. You'd like it to be nice and clean and wide aisles, but that's about it.
Right.
So lenders were far less careful about the types of tenants up until about 2007, 2008, during that last Great Recession that we had, which really affected broadly far more real estate industries than COVID.
Yeah.
COVID is really crushing retail right now.
Yeah.
The interesting thing, Eduardo, is retail was getting hammered well before COVID, because there's this tension with Amazon eating away at brick and mortar. And I don't know about you, I finance a lot of retail, but I really enjoy shopping on Amazon. I'm not a shopper. I don't like it.
Yeah, I'm the same way. When I find something, I just buy
Yeah.
it over and over again, maybe different colors or whatever, but
That's right. I just don't, women seem to like it more than men. Maybe that's an overgeneralization. But there has to be something which draws people back into the centers. And that's why kind of the Caruso approach is really the right thing to do.
yeah.
Eventually, people will be going to movies again. They'll just have to spread out more. Caruso centers always have very good restaurants, which are surviving better than gyms right now because of the fact that people are just doing takeout.
Right.
They're survivable.
Right.
So that's really the situation with retail, and why COVID has been really disastrous
Right.
for
Okay.
it. And it will come back, but it will be different. And so, just going back to your fundamental question, do the lenders carefully look over rent rolls? They do now.
Right.
On retail. They didn't
Right.
before. They're going to go tenant by tenant, and they're going to want to know, can this tenant survive? What do they do? What do they do? Can they survive? Are they well capitalized? And is it a use that, in our opinion, has legs or is potentially obsolete?
You said something super, I mean, it's interesting that you said that's a changing way to look at underwriting and of trends. I have a book right now, the link of like banking and lending throughout like the last 150 years. And I'm interested in reading it because there is changes that happen. In the residential loan market, you had these no income, no verification loans. Have commercial loans changed a lot, and have they become more restrictive or less restrictive? Is there more creative approaches to underwriting?
Yeah, it's definitely been it's gotten more creative, and when it gets ahead of itself, it starts seizing up. The residential loans and residential lending is reflective of this country's policies.
Okay.
And when you buy a house or a condominium, you are able to write off the interest. The reason is because the country wants to encourage people to buy houses. It makes them more stable.
Right.
Somebody who owns a house and lives there for their entire lives and then retires is
Right.
less of a burden for the country than someone who doesn't have that house and is a renter.
Okay. Yeah.
Because they sell their house,
Yeah.
they've got their nest egg. Even if they weren't smart enough to save, they still have that house.
Right.
And so as a country, our policy has always been to encourage home ownership.
Right.
And so going back to your question about this no income verification, that was something that Fannie and Freddie those are the buyers of these home loans from companies that originate them. They were buying those loans.
Right.
And so what that did is that just opened up the market to bad credit.
Right.
And what they did is, if you remember the analogy I used before about securitized loans, which are going into a trash compactor, they come out, and then the rating agency looks at all the assets in the trash compactor and goes, okay, 80% of those we're going to rate AAA.
Right.
The tragic and I don't know what other way to put it, fraudulent methodology of evaluating single-family loans was completely uncovered and resulted in the crash of 07 and 08. Go back and look at our analogy. We take all of these loans which are from people who don't qualify. They're 95% financing. They are all very, very weak credit.
Right.
It's going in the trash compactor. Millions of them.
Yeah.
We now have half a billion worth of loans. Okay, take them out of the trash compactor, take them over to the rating agencies, and the rating agencies, up until 2007, happily went, okie dokie, first 80% we're going to treat as AAAs.
Wow. Okay. And they
And
weren't.
it was crap.
Yeah.
It was people who couldn't qualify. It's not as if they put in a cross-section of everybody and then a very small section.
Yeah.
They would put specific pools of loans which were junky loans
Right.
and get them rated by the rating agencies who were complicit, and they all defaulted.
Right. Yeah.
Somebody who buys a $500,000 house because they've got a 2% rate, which has moved up to market to, let's say at the time it was 6%, is going to default as soon as it moves up to 6%. Because
Yeah.
they can't afford it.
Yeah.
They can afford 2%, they can't afford
Right.
6.
Right.
The market was at 6. These
Yeah.
people can't afford it. And so the brokers would get the people in the house telling them home prices or home values are going up 10% a year.
Yeah.
So you've got 2%, which is fixed for the next 3 years. Your $500,000 house should go up by 10% every year. So just make it simple. It's now worth $650,000 at the end of 3 years.
Right.
Mr. Homeowner, you've made $150,000 already. Right. Sell the house for $650,000. Buy another one using your $150,000 down that you just made.
Yeah.
And you never have to pay 6%.
Yeah. Yeah, that's the sell.
It's a great great program.
Yeah.
As long as houses go up 10% a year every single year.
Yeah, that's the thing. You can't really count on that all the time.
That means they double in value every 7 years. Yeah. So as a young person, you look at that house, you look at a house for $500,000, which seems cheap now, and you're going, geez, it's going to cost me in 7 years $1 million for the same house.
Yeah.
I can't afford that.
Yeah.
Or the flip side is I got to buy now, even though I can't afford it.
Yeah.
So it was a mirror game that remarkably went unpunished. Mm. It was not a mirror game; it was a shell game.
Right.
That went unpunished until the whole thing collapsed.
That was bound to happen.
It was bound to happen, and more of us, only a few people really kind of got it. More of us should have gone, this is going to blow.
Yeah. Yeah, you're right. I think
I don't think we appreciate it. And I'm a commercial guy, so I've got to kind of plead ignorance. Uh-huh. But I still knew enough to know that this is it was an unsustainable.
It seems unhealthy, yeah.
Yeah, and what the ramifications would be once it collapsed, never even thought about until they collapsed, and then we saw the ramifications.
What are the covenants different in commercial loans that maybe new borrowers would need to be aware of that maybe they don't think are a problem, that may be a problem down the road?
Okay, that's a good question. Generally, when one buys a property, buys a house and puts a loan on it, it is a non-recourse loan. Mm-hmm. It can become recourse once one refinances with a different lender. Okay. So buyers, borrowers, owners have to look very carefully at the loan documents to make sure that the loan is not becoming recourse. Because the recourse meaning it's personally guaranteed as opposed to just having the asset be the collateral for the loan.
Okay. That's for residential?
That's for residential.
Okay.
Residential loans also, in 99% of the situations, don't have prepays.
Okay.
So you get yourself a 3.5% loan and you think that you died and you went to heaven and you will never refinance for the rest of your life until rates become 2.5%.
Right.
You call up the lender and you say, we're refinancing. And the lender says, hot dog, let's do it. There is no prepay.
Right.
Commercial, on the other hand, you get a 10-year fixed rate loan. Let's assume for the first example that was 10-year fixed rate loan, home loan. Mm-hmm. You do a 10-year fixed rate loan from a lender, and there is a prepayment. Right. And they basically have gone out and either borrowed the money from the people who make deposits, or they have sold it in the secondary market, and they're expecting to get that return over the life of the loan. And so if you pay it off early, which you can, you must make them whole by paying the interest, which is outstanding for the rest of the term of the loan, less what the lenders can reinvest that money in, you guessed it, T-bills.
Wow, okay, so yeah, the spread you have to make up for.
So let's say that we do, on one of your projects, we do a 10-year fixed rate loan right now, and it's at 3%, and you are loving life.
Right.
Okay? 6 months from now, somebody comes and says, I love your property. I want to buy it. It's just perfect for my location. And I don't want a loan. I'm all cash. And you say, if you have to have this property, you're going to have this property, and I will sell it to you. You pick up the phone, you call the lender, and you say, I need to pay off the loan now. Lender says, presuming it's in the loan documents, not a problem, Eduardo. Okay, your prepayment is going to be the difference between a 9.5-year treasury, and let's just say that would be 60 basis points, and the 3.5% interest. Let's just say it's 50 basis points because we can do it in our head. Okay, the 50 basis points, which is what a 9.5-year treasury would go for today, and the 3.5% coupon rate, that's 3%.
Yeah.
Times 9.5.
Yeah.
Right? Pay us back, it's not a problem.
Yeah.
Instead of taking your money and reinvesting it in other real estate loans, most loan documents give the lender the obligation only to reinvest in treasuries.
Okay.
So
Wow.
you're paying, after having that loan for 6 months, you are going to pay a prepayment penalty of about 25% of the loan amount.
Okay.
So
Wow. Okay.
you needed to have gotten a very good offer.
Yeah. That makes sense. That is something to concern.
Right.
One other thing that I was thinking of was, we were helping my uncles look for properties.
Right.
And one of the concerns was to get a longer term loan, and then there's a balloon payment at the end of like 10 or 15 years, even though it's a 25-year amortization loan. One of the concerns we always looked at was if the balloon payment was something that could easily be paid off if financing was difficult to achieve, or or for whatever reason, just to have that safety net. So that was something else that we were looking at. I know you have to go, so let me ask you my wrap-up questions.
Sure.
So what is your best lesson that you've had in your 30 years? Or I didn't want to speculate. I know.
Thank you. It gets pathetic when it's over when it's over 20, I've been told. So I say over 20.
Okay, over 20. So much experience, so many cycles. What's the best lesson you've gotten out of all that experience?
Yeah, lower leverage, long-term fixed rates.
Okay.
That is, do not over leverage, and it really is. Your dad has the perfect philosophy for surviving, and that is keep all your assets, prime assets, keep the leverage extremely low.
Okay.
And be smart. The difference, though, is he will not make nearly as much money as somebody who leverages higher and takes a higher risk.
Right.
Of those people who will leverage higher and take a higher risk, a third, a half, maybe more will lose it all.
Wow.
But of those who have done it right and are able to hop off, it's musical chairs, right?
Yeah.
Get their fannies into a chair immediately when the music stops. They'll generally be fine, and they'll make more money because they've leveraged more.
I've heard it said that it's really a game of luck when you leverage a lot. You never know when, like,
It's
the musical
chairs.
Yeah, it's another way to put it. It's very true.
Yeah.
So for the second question, and it's an honor knowing you. The way you've built your career, you joined George Elkins in 1992. You ended up buying it out with a group of investors and then selling it to Walker Dunlop. I mean, and now you're vice president there, or managing director. What are your 3 key daily habits that have helped you get success? Or just what's your mantra, I guess, to help you achieve so much in your life?
That's number one, thank you for saying that. It's very flattering, and I appreciate it. You and I have been friends for a while, so that means a lot to me. Get good at something where you are better than most people in your industry.
Okay.
And the longevity helps, but unless you are really up to date and sharp on the changes, because when I started in this business, there were no computers, there There were no fax machines. There were no HPs. Everything was mailed overnight, and things changed. So what I have learned is I have to surround myself with people smarter than me. I've got certain fundamental strengths that I am, in my mind, very good at, and I have a myriad of weaknesses. And I must have people that I work with who can handle the weaknesses. And the weaknesses are generally technical for me. I'm just not a technical wonk. And I could learn it, and I've got some friends my age who have learned it, but I can leverage better if I have people who are smarter than me, who totally understand that, and I can leverage them off of a whole area that I would need to learn, and I can continue going out and focusing on the areas that I'm strong in.
Right. Okay.
So I guess the long and the short of it is, be realistic with your skill set, and if it is not at the top of your market, it may not be what you should be doing.
Right. Interesting. Okay. Well, that's an exploration for everybody.
Yeah, it really is an exploration. We all find out.
You know, I read today, I don't know, it was a quote. It was Picasso, I think, that said it, that I think the finding what you're good at is like the mission of life, and then giving it away to other people is the meaning of life, something like that.
Yeah,
or I mean, I'm probably butchering it, but it was,
Yeah.
I wanted to revisit it. It was in the passing of the day that I saw it.
Yeah, well, you don't get good. You're just not good at something immediately.
Yeah.
It's got to be interesting to you before before you can even learn about something. It's got to be interesting. You know, I always wanted to be a doctor, but I couldn't pass chemistry for the life of me. It just was gibberish to me.
Yeah.
All the symbols and the way that everything worked. Law school was fascinating. I loved it. I see in pictures, and I see. When I look at a property, I can see the numbers in my head and run them in my head because I've done it so much. But that's just the way that I am. So if I'm trying to figure out what I'm good at, I'm visual.
Right.
And I'm really, really good at very simple math that I can do in my head.
Yeah.
And I like 9-inning baseball. And I like, in particular, playing 12 9-inning baseball games at once. And that is what real estate finance is.
Why 9?
Because it's got a beginning and and an end.
Right.
It's a 9-inning game. It can go to extra innings if it's a particularly long transaction or it's a problem or this, but it's got a lifespan.
Right.
And so I love working on multiple transactions, as we talked about in the beginning.
Yeah.
Anywhere from an outpad in Fresno to a $500 million stock co-op, they're all as interesting to me.
Yeah, really, that's interesting.
Oh, they really are. Particularly, working with you as you're going out and getting into new deals. I'm thinking, I love the way that you think. I love your enthusiasm, and it's really important to me that you get the right type of structure. And that you understand what you're doing, and so that's a joy to me.
Well,
working with you and stuff like that.
It is fun. You are one reason why you really understand the people you work with. I don't know if it's your legal background that's sort of helped you learn, keep an open mind with different business strategies, but I don't know how your legal has influenced the way you operate. Is there a way that it's...
Yeah, it's given me discipline and thought, because I have to organize the fact patterns, whether it's, as we talked about earlier, running over your foot, or whether it is redeveloping Santa Monica Place.
Yeah.
I've got to understand it and see it and believe it before I can articulate your vision to third parties.
I see. Yeah.
So, and it's got to make sense to me. If it doesn't make sense to me, and I tried it when I was younger, going out and pitching things which I didn't understand, I would be laughed out of the room.
Yeah.
Have you thought about this? Have you Jeff, have you gone into the, I remember working on a fish storage warehouse one time, and the lender said, there's no need for a fish storage warehouse right here.
Yeah. Yeah.
And I said, well, here it is. And
Yeah.
they said, there you go. We'll see you.
Yeah. Yeah. No, that it feels that way. It feels when we talk to you, you get it. You understand. It's very fun working with you because you see it from our perspective, or from the perspective of the
Both
business
sides.
plan and the philosophy, the background, because it is more than just the numbers. It's really the culture of the buyer.
Yeah, yeah.
So-
one of the calls I got, and then I've got to run, was from a group that owns a good deal of land in Colorado near the railroad.
Okay.
And they're buying it, they're going to redevelop it for kind of railroad stuff.
Mm-hmm.
And what I need to do, my job is now to translate their vision into lender speak, because the lender will be horrified when they see this remote land in the middle of nowhere near nothing but a railroad. And these guys are visionaries and they're big hitters, but they have not properly articulated their goal in a manner that I can sell it to a lender.
Yeah.
So I've got to work with them to A, figure out if it makes sense to me,
Yeah.
and B, then translate their vision into lender speak.
Yeah. No, I get that because you do. I find it super interesting how you make brochures and you market the loan.
Yeah.
Almost like you're marketing a property, and there's a lot of similarities in it.
Oh, yeah.
But
From my perspective, the lenders are buying the loan.
Yeah.
They're buying the property,
Yeah.
right? Not for you guys because you guys are chickens,
yeah.
but if a lender's lending 70% on a property, they're putting in most of the dough and they're getting 3%.
And I mean, it is a partnership, maybe not legally,
Exactly.
in legal terms, but
Yeah.
it's a whole ecosystem of people working together and having a synergy.
Absolutely.
Come meet us over at signetinvestments.com. There you'll have access to our full podcast and articles archives. Also, if you subscribe there, you'll get new updates sent straight to your inbox. You can also find us across all social media platforms. Our handle is Signet Investing. Thank you and invest wisely.